Hi, I'm John Gilmovich from Real Property Manager.
Hi, I'm Debra from the Property Frontline.
And hi, I'm Ken from Avvora Finance. Thanks for joining us on this session. You're with Property Mythbusters. We're here to bust myths around contradictions and misleading information in the property space. And for the next 10 minutes, we'll just be going through a February market update, just so that you kind of get an idea on what's happening, in the credit space, the property space, and the rental space. So I'll get straight into it and share my screen. So the first thing, what we're seeing is a lot of purchasing inquiries. People who are wanting to purchase property, and this is primarily led by the owner-occupiers, so people who are either looking for their first home. That's what I'm generally seeing, or possibly upgrading. So you can see here recently there has been, so this is covering a couple of years, and if you're looking at just a few months, it will just be this slither of the graph. But you can see here total lending has increased. It's been primarily driven by owner-occupiers, but something that's interesting is that the investors are starting to come back into the market. And there certainly isn't a whole raft of investors coming on board, but they certainly are starting to look at purchasing property. So that gives you an indication in terms of where the mix is for people who are looking at getting home loans at this point in time. I have seen a few investors out in the marketplace at Open Homes, because I follow the Star Partners Auburn team on the weekends. So that's just something that's quite interesting that I'm seeing kind of take place. In terms of interest rates, they're relatively stable. I think there was a client who fixed their rates last year, and they're kind of seeing that they're probably off by almost 1% at this point in time. I'm not saying that fixed rates are the way to go, but it still has moved since then. And back then the conversation, I think the client didn't believe that the interest rates would go lower, but I wouldn't certainly choose fixed or variable based on interest rates and other factors, whether, you need to do the forecasting. It makes forecasting easier with fixed rates, whether you're comfortable with variable rates increasing, whether you've got the capacity to make advanced repayments, whether you're wanting to refinance or sell the property, potentially sell the property, in the coming years. An example might be, you might be thinking you've currently got an investment property, you want to refinance now, but you may have a little one along the way, and you might want to kind of upgrade or buy your own home and have the option to sell the property. So there are a lot of scenarios, I guess, where that could play out. I just thought I might mention that, it sometimes seems a little bit strange how you're not sure if you're going to sell a property in, 1 to 3 years or 5 years. So the other thing is, there's still a lot of activity with the lenders wanting to offering cashbacks and incentives to refinance your home loans. So if you haven't looked at your home loans in the last 3-5 years, let's just say, now would be a good time to visit and just check to see where your home loan is at this point in time. So there does seem to be a lot more activity out in Open Homes, just talking to prospective buyers. The sentiment seems to have shifted away from, being uncertain in terms of where the property market's going to being relatively confident. It's just finding the right property. And yeah, I guess, Deb, were you kind of going through next in terms, because I do have a nice little segue, because I'm seeing a lot of the real estate agent out in Auburn anyhow. So that's where the information's coming from, that segment of the market. Houses seem to be doing better as opposed to units in general. And we're talking about the large complex units.
Yeah.
What are your thoughts on that? Or
So it is the case that houses have really skyrocketed. There was one example just last weekend where a property in Miracle was guided at about 1.3, and it sold at auction. So 1,730,000. It was just ridiculous. But anyway, I will share my screen.
But you know why that happened, Deborah?
Why?
It's those Marrickville pork rolls that they sell there.
The pork rolls.
World famous now. World famous. I saw the lineup on Saturday. It was like 30 meters long
Yeah.
Get close to
for
the
a
action.
pork roll.
Rolls.
People
That's-
waiting for half an hour to get a pork roll in
Yeah. But
Marrickville.
anyway, yeah. So
Amazing.
across the board, the number of serious buyers has really bounced. So this is what we're looking at here. This is a tracking graph from realestate.com, who've been doing some great stuff with their stats. And from this, we can see this is when the COVID restrictions first started coming in. This is December 19, January 2020, when we were actually heading into a really hot market. You could feel the momentum building at that point. And so we took off really fast. Then we hit the brick wall of the restrictions, but then it turned around very, very quickly. And this is the Melbourne lockdown period. And then that's the December slammer. And from there, so this is the 1st of January 2021, and now the 1st of February, basically. And so realestate.com says that the number of serious buyers in the market right now is 53% higher than the same time last year. So that's why we're seeing, people scramble, and houses are definitely more popular, but units are really, unit interest for bargain hunters is really increasing as well. So it only takes a couple of weeks before real buyers get out into the market and go, oh, this house market's really too hot. Is there any bargains in units? And so there is a danger with that I'll talk about later, but very, very hot, not only on the East Coast, but right around the country. This graph here is another realestate.com. So this is the amount of searching that realestate.com has seen on their site. And they're basically saying buyer search volumes have increased for 6 weeks running and are now 65% higher than they were at around about the same time at December 19. So it's, just really crazy. Even here, so yeah, you can see here, these are the legit clearance rates from SQM, because we can get auction clearance rates just over the weekend, but they're usually a bit frothy. And on Tuesdays, SQM publish their clearance rates. So Sydney's 71%, it's just really hot. And then the other point I wanted to make was that this is the reason why we're hearing from the RBA that they're not going to step in just yet, even though the market is crazy. And the reason for that is you can see we're really down. House prices nationally are still lower, around about 10% lower than, I guess, a sort of more consistent kind of market would deliver. So it'll be a little while before the RBA steps in, but we will see this little marker here go for a very sharp bounce, because it's already happening. And so now we know that we've seen the bottom of the market, which would have been around about October or November last year. And now it'll be the guessing game of how long will it be before the RBA steps in, because they will if necessary. And here's hoping they don't have to do what they're doing in New Zealand. So have you heard what's going on over there?
Nope.
So in 2020, New Zealand house prices across the board bounced by 20%. And so their financial institutions had to, they were starting to try and cool the market. And what they have just announced is that they will be changing the lending criteria for investors in New Zealand. They will have to put in a 40% deposit. But that doesn't come in until May. So that is like fanning the flame even more for investors. But anyway, yeah. So we will expect to see something like that happen. The market is way too hot. For me, it feels like I'm in 2017 where, you know, people were like fighting over the top of each other to actually get to the front of the queue, and were, you know, we were seeing like 5 or 10% almost for like the hot suburbs. They were leaping each month. But anyway, it is what it is. My advice to buyers, though, you need to quiet the market noise and really focus on your strategy, because the market will always be doing weird things. And these numbers that we're talking about here are at a national or at best a state level. And so the area that might be right for you might be less active. And so, you know, it's really like, don't get scared. So that's it for me. So John, what's happening on the rental side?
Okay, so let's have a look at the nation's rental market status. And I think last time we spoke was around about December.
Yeah.
Of 2020. Let me have a look here. Debra, I'll bring a few things up.
This looks good.
That's actually not my graph.
Ah.
New share.
Sorry?
Okay, here it is here. Let's roll back a bit. So we're discussing, we're going to have a look at where things are moving along. So rises versus the declines in rents. And that's kind of what's happening at the moment with the rental market, is that some suburbs are thriving and lower vacancy rates are occurring. Even a little bit of rent increases are occurring, and other markets continue to fall with high vacancy rates and lower rents. But before we have a look at that, this is the kind of the trend, if you like, at the moment by CoreLogic around investor confidence. And if you just browse your eyes over that and just have a look at the direction or trajectory of each marketplace, there is much lower confidence from the investors, and obviously that's because of the declining yields in most capital cities, as well as what's happening with the rent moratoriums, which of course kicked in back when COVID hit. So the legislation around rent moratoriums basically means that as an investor, you have less control over the tenancy situation, and the tenants continue to have more control if they are financially impacted through COVID, lose their jobs or have declines in income. And that means that you are forced as a investor to negotiate, defer rent or potentially reduce rent for X amount of time until they're back on their feet. Now, of course, that's not terrific news. Nobody wants to as an investor, be in that situation. And so currently, while the moratoriums, which are either have been extended across pretty much all capital cities across the states, and in particular, 26th of March plays an important role in this year for New South Wales, where rent moratoriums at this point haven't been extended, and they are due to end in March 2021. And so that's going to be a crucial key as to how things play out for the investor market, and how the rents will bounce back. So over the last 12 months, the biggest falls, as you can see in this graph supplied by, these stats supplied by Domain, and these are apartment rents. You can see there's been some pretty heavy duty falls, and these are just some of the suburbs, not all of the suburbs. Of course, the inner city market and the CBD have been highly impacted, around 15-16%. Areas like Pyrmont, Surrey Hills, Darlinghurst, and the CBD itself have had double-digit falls. Darlington, obviously, there with on the outskirts of Redfern, and Millers Point, of course, the Rocks area, Barangaroo, we can see some double-digit falls that have occurred, and that's continuing. So biggest falls in the house rents, also in the double digits. And Ken, you mentioned sort of like that disparity between apartments and houses. Okay, I'm seeing at the moment that there is much higher demand for established houses, detached houses, rather than the apartments, and the numbers of prospective tenants that are coming through the open homes. Right. Big differential, average of about 3 to 4 groups, let's say, for average, 2-bedroom, 2-bathroom apartment versus, for example, a house that I had also, Deborah, in Marrickville, where 25 groups came through and 7 lots of applications last weekend. So massive disparity between the houses and the apartment market. And where have the rents risen? Well, they've risen quite a lot in those lifestyle areas. Palm Beach topping the list. And who wouldn't want to live in Palm Beach, of course. So lots of demand, beachside suburb, scarce on stock, and pushing, almost 30% price rise in the house rent over the past 12 months. Dover Heights, of course, also close beachside suburb, Balgowlah, Sylvania, Narrabeen, and of course our Central Coasts. So Avoca Beach topping the list of risers. Big demand on the Central Coast at the moment for the sea changes, and even a little bit inland, places like Kenthurst, those kind of lifestyle acreage properties. The families love the outdoors with the kids running around, the big backyards. Get out of the city, apartment living, and out into a bit more open areas. Manly Vale, of course, as well, beachside suburbs. So lots of demand and trends going through to the established homes out of the Sydney, a little bit further out of the Sydney, in a circle, that 10K, 15K radius, and a little bit further out and down to the Central Coast area, all of course part of the greater Sydney. Biggest rises in Sydney rents. So as you can see there, Glenfield Banks Meadow, quite a evolving suburbs as well, getting lots of infrastructure there, lots of brand new apartments getting built. And Pagewood, of course, is also very, very, going through a bit of a gentrification. The Pagewood area itself, which taps into, Maroubra Beach area, of course, Malabar, La Perouse, so literally, 10 minutes here or there next to the beach side, opens that up opportunity. And again, Central Coast, Edelong Beach, Avoca, those nice sort of inner city Birchgrove, of course, part of the Balmain Peninsula, Tamarama Beachside, and Revesby is a surprise. Bit of demand there for apartments, but Revesby is one of those areas, part of the Canterbury Bankstown area, which is a very highly developed apartment market at the moment. So it's come into the list because generally it hasn't been an area that you'll be sort of putting on your radar for apartment living. So it's opened up a little bit of a market there. This is an interesting kind of postcodal data there from Riskwise Property Research about the 10, not in any particular order, but 10 postcodes of unit oversupply. And obviously, as an investor, you have to be wary of the general strata apartment oversupply, and of course the Docklands area, that CBD area, very high density area. Mascot in Sydney.
Sorry, Duncan, how long do you reckon Docklands has been on that list?
Docklands has been on that list for quite some time now, and it continues to be at as a risky oversupplied area. And of course, we'll be talking about this in a fortnight's time. Docklands is very, very, very centred around those Airbnb lettings, Deborah. And of course, that market's been decimated, and those property investors have had to return those properties back into the permanent rental market in hope for rental income.
Yeah.
Mascot, Rouse Hill, Parramatta, of course, turning into very high dense strata apartment living areas. Gosford, well, Gosford's part of the Central Coast, but still part of Sydney Metro. A lot of development. If you drive through Gosford itself, there are development sites galore going on there. So it will become a very high dense area of apartment living, and in particular developers are targeting the sea changes from Sydney to move across. Darwin, of course, development galore going on there. Queensland, West End surfers, of course, we know traditionally very high rise area, and centre of Adelaide. So these have been earmarked as the high risk oversupply areas, and of course that will have or is already having effects on the rental values. So that is where the market is at the moment, all tied in with that key X factor around the rent moratoriums, whether they're staying or going. If they are relaxed, I can see some improvement for the investors and some more confidence. But if they aren't, I can see investors sitting on the sidelines until that's resolved.
And what do you think about bargain buys for active actively looking right now?
Look, if your vision is long term, and you can write out the low yield environment, possibly for the next 3 to 5 years. That's the window I'd be looking at. If you can write out that low yield environment, and you come across an apartment that's value, and when I say value, well, if it's off from its original purchase price in the last 5 years of anywhere between 15 and 20%, which is possible, Deborah, in this market, I'd seriously be looking. At.
Yeah, because we expect there will be a really big crunch. Like, we won't be able to get enough units because they're not building enough to meet future demand, are they?
Yeah, so building starts are obviously on the decline at the moment, and that's purely from a demand driven. But once like the international borders open up, obviously we're on the tip of the vaccine rollout. There'll be more confidence coming back slowly into international travel, and of course the capital cities are very tied into influx of immigration and skilled migration, which we're lacking at the moment to fill all these apartments. If you can write it out, the 3 to 5 years, it's worth looking at.
Yeah, I think so too.
One thing I'd probably mention from a broker's perspective, or from a home loan perspective, with units specifically, if you are kind of considering entering that market, you'd probably need a decent deposit, 20-30%, something like that, because some lenders still do have high density restrictions, and how they define a unit as high density it depends on their own credit policy. So for example, one lender might say any units in a specific postcode is considered high density, whereas another might add another layer of criteria. If it's in a postcode and has more than 10 units, then it's classified as high density. So it doesn't limit all lenders, but usually speaking, when talking to clients, it's ideal to have as many options open to choose from, and that also kind of affects the interest rate that the home loan product will end up on. But that's just something to consider as well. If you are looking at units specifically, there isn't really any criteria for like townhouses, villas, even houses. So that's just something to consider.
Okay.
Yeah, so I guess the key there, Ken, is kind of don't go weekend hunting and just buy a strata apartment thinking that it's easy finance. You have to pre-qualify and make sure that you get that pre-approval and know how much skin in the game you're going to need, whether it's 15%, 20%, or possibly more, depending on the postcode.
Yeah, pre-approval is absolutely essential, particularly in the market that we're in. So, John, do you want to wrap up?
So yeah, that's it from us this week. Thanks for joining Property Mythbusters. Of course, you can find us on our social media site on Facebook and YouTube, and of course our individual websites, avvorafinance.com.au, realpropertymanager.com.au, and propertyfrontline.com.au. And we'll see you in a fortnight's time for another great topic. And so it's over and out from all of us, and take care.